IBM shares fell as much as roughly a quarter today. For most stocks, that kind of move already tells you something bad happened. For IBM, it tells you something more specific. This is not a tiny biotech missing a trial. This is not a pre-revenue AI stock losing a customer. This is IBM, one of the oldest enterprise technology companies in the market. A company investors often treat as boring, profitable, dividend-paying, and maybe finally interesting again because of AI, Red Hat, hybrid cloud, mainframes, and free cash flow. So when a stock like IBM falls roughly a quarter in one session, I do not want to start with a lazy line like earnings were bad. That is not enough. The real question is, what did the market think IBM was, and what did today's disclosure break? My answer is this. The market did not suddenly decide IBM is worthless. The market decided the confidence premium was too high. IBM had been priced like a dependable execution story. The July 14th preliminary second quarter disclosure cracked that story. That distinction matters. A company can still be profitable, still pay a dividend, still own important assets, and still deserve a lower stock price if investors were paying for reliability that just got damaged. That is what I think happened here. Not because IBM stopped producing cash, not because the dividend disappeared, not because Red Hat vanished, but because management basically told investors software and infrastructure missed, client buying behavior shifted, large deals did not close on time, and we did not move fast enough. That is the part the market hated, not just the numbers, the admission, and for me, that is the detective angle. This video is not a buy the dip video. It is not a sell the panic video. It is a trust audit. I want to know whether this is a one-quarter execution stumble inside a still healthy IBM transformation, or whether the market just found the first real crack in the AI and cash flow story. Here is the factual setup. On July 14th, IBM furnished an 8K and published a letter to investors from Arvind Krishna. The company said it was releasing selected preliminary second quarter 2026 results. Preliminary matters. These are not the full final earnings yet. The regular Q2 earnings call is still scheduled for July 22nd. But the market did not wait for July 22nd. The market saw enough. For Q2, IBM said revenue was $17.2 billion, up 1%. Software revenue was up 5%. Consulting was flat or up 1% at constant currency. Infrastructure was down 7%. Gross margin was weaker on a GAAP basis and also weaker on an operating non-GAAP basis. GAAP diluted EPS was $2.27, down 2%. Operating non-GAAP EPS was $2.93, up 5%. Year-to-date, net cash from operating activities was $7.8 billion. Free cash flow was $4.8 billion. Now put that beside what investors expected. The reported consensus expectation was about $17.86 billion of revenue. IBM came in around 3.7% below that. The reported adjusted EPS expectation was roughly $3.01 to $3.02. IBM came in at $2.93. That is roughly a 2 to 3% EPS miss. So the math is important here. The stock did not fall roughly a quarter because revenue was down 25%. Revenue was not down 25%. The stock fell because a smaller operating miss forced investors to reprice a much bigger trust premium. So pause there. This is why the story is subtle. This is not a company with no revenue. This is not a company burning cash with no business model. IBM still has massive revenue, profits, free cash flow, and a real enterprise customer base. That is why a simple bad quarter explanation feels too shallow. The market reaction is not just about whether IBM made money. It is about whether the market can still trust the cadence of the story. Because the Q1 story was very different. In April, IBM reported first quarter revenue of $15.9 billion, up 9% or 6% at constant currency. Software was up 11%. Infrastructure was up 15%. Free cash flow was $2.2 billion for the quarter. Management still expected full-year constant currency revenue growth above 5% and free cash flow to increase by about $1 billion year over year. That was the confidence setup, broad-based growth. AI data infrastructure, Red Hat, Confluent mainframe cycle, free cash flow, dividend, debt management, an old company starting to look newly relevant. But I also do not want to make the story too clean. Q2 may not be the first crack. It may be the quarter where cracks that were already forming became impossible to ignore. Even after the strong Q1 headline, investors had reasons to ask how much of the software growth was truly organic, how much was acquisition-driven, and whether AI would help IBM's software story or disrupt parts of it. That is why today's sell-off feels so violent. It is not just a reaction to one preliminary quarter. It is the market looking back and saying, maybe we were giving IBM too much benefit of the doubt. Then Q2 arrived and the setup changed. Yesterday's implied story was simple. IBM is not the fastest grower in tech, but it is becoming more reliable, more software heavy, more AI relevant, and more cash flow durable. Today's disclosure said something different. Software slowed, infrastructure missed. The mainframe cycle did not translate cleanly. Large deals slipped. And management admitted the company did not move quickly enough. That is why the move looks so violent. The market was not only marking down this quarter, it was marking down the assumption that IBM's transformation had become predictable. I think today's drop comes down to 4 broken assumptions. The first broken assumption, software growth was supposed to look more durable. The second broken assumption, the mainframe and infrastructure cycle was supposed to be manageable. The third broken assumption, IBM was supposed to execute like IBM. And the fourth broken assumption, the growth story was supposed to look increasingly organic, not increasingly dependent on acquisitions and portfolio mix. Let's walk through each one. Software is the heart of the modern IBM bull case. If IBM is just legacy hardware and slow consulting, the stock deserves a very different multiple. But if IBM is hybrid cloud, Red Hat, automation, security, data, AI tooling, and high-margin enterprise software, then the story gets more interesting. That is why software slowing to 5% growth matters. 5% is not a disaster by itself, but it is a problem when investors were leaning on software as the quality engine. In Q1, software was up 11%. In Q2 preliminary results, software was up 5%. That step down is the first wound. And if I were listening to the July 22nd call with a notebook open, this is where I would circle one word: organic. Reported software growth is useful, but if software growth is being helped by acquired assets while older software pockets are slowing, that is a different quality of growth. I am not saying that is definitely what happened. I am saying that after a quarter like this, IBM has to prove the quality of the growth, not just repeat the headline growth rate. Management said part of the shortfall came from the associated software stack around the Z mainframe cycle, especially transaction processing. That matters because IBM's mainframe ecosystem is not just a hardware sale. It has software, support, and transaction processing economics around it. If the Z cycle is not flowing through the way investors expected, that hits more than one line. The second broken assumption is infrastructure. IBM said infrastructure revenue was down 7%. Management had expected infrastructure revenue to decline low single digits for the year, beginning in Q2, as the company wrapped around the Z17 launch. Instead, the result was worse than expected. The explanation is important. Management said clients shifted quarterly capex towards servers, storage, and memory purchases to secure supply-constrained infrastructure ahead of expected price increases. Plain English, customers had a budget. Some of that budget moved toward infrastructure items they felt they had to secure right now. That changed buying patterns, and IBM did not fully anticipate the magnitude of that reprioritization. But here is the part I do not want to skip over. That explanation sounds a little awkward at first because IBM also sells infrastructure. So if customers were shifting money towards servers and storage, Why did IBM's total infrastructure revenue fall 7%? The likely answer is mix. Distributed infrastructure was strong, power and storage were strong, but the expected Z mainframe and transaction processing software economics did not come through the way investors wanted. So the question is not simply, did customers buy hardware? The question is, did customers buy the right IBM hardware at the right time with the right software attached at the right margin? That is a much more precise question. Management also cited rapidly evolving industry-wide cybersecurity concerns that distracted clients during the quarter. That is a real-world enterprise sales issue. Big companies do not buy technology in a vacuum. If budgets get redirected, supply chains tighten, cybersecurity priorities change, and procurement gets slower, enterprise deals can slip. But here is why the market still punished IBM. Enterprise complexity is not new. IBM is supposed to be good at this. That leads to the third broken assumption, execution. Management said the conditions required perfect execution, and this quarter they faltered. That is the line. That is not my interpretation. That is the company's tone. Large deals failed to close on the expected timelines, and those timing misses drove the majority of the shortfall. This is where I do not want to let management off too easily. A slipped deal is not automatically a lost deal, but it is not proof either. It is a promise sitting in the future. If those deals close cleanly in July, August, or the second half, bulls can argue the market overreacted. If those deals keep slipping, get resized, or quietly disappear, then timing issue becomes a softer way of saying demand was weaker than expected. That is why July 22nd matters so much. When a smaller company says that, investors get annoyed. When IBM says that, investors ask whether the reliability premium was too generous. There is a bigger question under this quarter, and honestly, this is the part that makes the video more interesting than just IBM missed numbers. Is this only an IBM execution problem? Or is this a warning about enterprise tech budgets more broadly? Because management's explanation is basically saying clients had to make choices: servers, storage, memory, cybersecurity, supply constraints, expected price increases, delayed software, and services decisions. That sounds like a budget allocation story. And if AI infrastructure spending is forcing companies to prioritize hardware, chips, memory, security, and capacity, then the risk is bigger than one IBM quarter. Maybe the spending comes back later. Maybe it is just timing. Maybe Q2 was messy because buyers were front-loading infrastructure purchases. But the uncomfortable question is this: what if AI does not simply add new enterprise software demand? What if it also crowds out some traditional software and consulting budgets for a while? That is why I think this quarter mattered to more than IBM holders. It raised a question for the whole enterprise software stack. Now, why roughly a quarter of the company's market value? That feels extreme for a company that still reported operating EPS growth and free cash flow. But stock moves are not only about current earnings, they are about changed expectations. Before today, IBM had a clean story. It was not the fastest AI stock. It was not the flashiest cloud stock. But it had something many AI names do not have: cash flow. That is the confidence premium in plain English. Investors were not paying only for this year's revenue. They were paying for the feeling that IBM had become boring in the right way. Stable enterprise customers, sticky software, mainframe economics, Red Hat growth, a dividend record, and enough AI relevance to keep the multiple from feeling like old tech. When that kind of story breaks, the stock does not need a solvency crisis to fall hard. The multiple can compress first. Enterprise relationships, Red Hat, mainframe durability, a dividend, a consulting arm, a route into real enterprise AI budgets. That combination can earn a premium if investors believe management can execute predictably. Today, that predictability got questioned. The market is not saying IBM has no business. It is saying the story needs a lower multiple until management proves the miss is contained. That is the difference. A bad quarter hits the income statement. A broken confidence premium hits the valuation. And this looks like a valuation reset. The clearest clue is that the numbers were not all terrible. Operating non-GAAP EPS was still up 5%. Operating non-GAAP pre-tax income margin expanded. Free cash flow year-to-date was $4.8 billion. Red Hat growth accelerated sequentially to 11%. HashiCorp and Confluent were described as performing strongly. Distributed infrastructure was up 37%, with strong power and storage growth and about $500 million of backlog exiting the quarter. Z17 remained nearly 130% program to program. That phrase needs translation. Program to program does not mean Q2 revenue grew 130%. It usually means the current mainframe launch is being compared with the prior mainframe launch at a similar stage. That can still be good. Well, but it does not prove that shipments landed exactly when expected. It does not prove the software attached at the expected rate. It does not prove transaction processing revenue followed the hardware. And it does not prove consulting work converted on schedule. The real question is not whether Z17 demand exists. The question is whether IBM can monetize the whole ecosystem around each system. Those are not dead business numbers. But the stock still got hit. That tells me the market was not only looking at absolute profit, it was looking at the reliability of the bridge. Can IBM really turn AI, hybrid cloud, Red Hat, Confluent, mainframe, and consulting into consistent growth? Today, the market's answer was prove it again. Now, let's be fair. I do not want to pretend this is all bearish. The bull case did not disappear today. It was damaged, but it did not disappear. The strongest bull argument is that IBM still has assets most companies would kill for. Red Hat is still strategically important. If Red Hat growth accelerated to 11%, that matters. Enterprise hybrid cloud is not going away. Large companies still need systems that work across public cloud, private cloud, legacy infrastructure, regulated data, and internal workflows. That is where IBM wants to sit. The second bull argument is that the acquisitions may strengthen the data layer. HashiCorp and Confluent are not random assets. HashiCorp matters for infrastructure automation. Confluent matters for real-time data streaming. If AI agents, enterprise automation, and real-time decision systems become more important, trusted data pipelines become more valuable. That fits the IBM strategy. But I would still watch one thing carefully. I do not want acquisition language to hide the organic software question. If IBM's software growth is helped by acquired assets while important legacy software pockets are slowing, the quality of that growth matters. The July 22nd call should help separate Red Hat, HashiCorp, Confluent, transaction processing, automation, data security, and AI tooling. Because not all software growth earns the same multiple. The third bull argument is cash flow. Even in a disappointing preliminary quarter, IBM reported $4.8 billion of free cash flow year to date. That gives the company room to invest, room to pay the dividend, room to manage debt, room to keep funding long-term bets. But I want to be careful here too. Free cash flow is not just a trophy number. I want to know the quality of it. How much was operating strength? How much was working capital timing? How seasonal is it? How much of the annual free cash flow target has already been earned? How much cash does the dividend need? And how much flexibility is left after debt acquisitions, AI investment, and quantum investment? Also, when we talk about IBM debt, I do not want to be lazy. The company reported $66.4 billion of total debt at the end of Q1, including IBM financing debt. Financing debt is not identical to ordinary operating debt because it sits against financing receivables and customer financing activity. So the clean version on July 22 is gross debt, financing debt, core debt, cash, and net core debt. That is the debt bridge I want, not just one scary gross number. The fourth bull argument is that the mainframe story may be delayed, not dead. Management said Z17 remained nearly 130% program to program, ahead of Z16, with clients representing 85% of installed MIPS, maintaining or growing capacity. That does not sound like the product cycle is dead. It sounds like the revenue timing and associated software pull-through disappointed. Those are different problems. One is structural, one may be timing and execution. The July 22nd call has to help investors decide which one this is. The fifth point is long-term optionality. But I would not call it current operating proof. Management highlighted Lightwell as a $5 billion commitment around open source software vulnerabilities, with large financial institutions named as early adopters. Management also discussed Andron, a quantum wafer foundry plan supported by a $1 billion CHIPS incentives letter of intent and a $1 billion IBM cash contribution, plus plans to invest more than $10 billion in quantum over 5 years. That is real ambition. But ambition is not enough. Lightwell may become important, quantum may become important, government-backed strategic technology may matter a lot over time. But as a shareholder or analyst, I would not use those as a free pass for a weak quarter. Those projects are optionality. They are also demands on management attention and capital. The market today is basically saying, show me the operating translation. Do not just show me the moonshot. Show me software growth, deal closure, cash conversion, and guidance credibility. The bear case also got stronger today, not because IBM suddenly became a fraud or a dying company. That is not the right framing. The bear case is more practical. First, if software growth can slow this quickly, the quality engine may be less smooth than investors hoped. Second, if the mainframe cycle is still strong, but revenue and associated software underperform, the timing and mix of the cycle are harder to model. Third, if clients are shifting budgets because of supply constraints, price expectations, and cybersecurity pressure, IBM may have less control over the enterprise buying cycle than the bull case assumes. Fourth, if large deals slip, consulting and software momentum can look good in backlog or signings, but fail to hit revenue when investors expect it. And this is the dangerous part of the bull explanation. The deal slipped sounds temporary. Sometimes it is temporary. But slipped enterprise deals can also reveal budget friction, weak urgency, pricing pushback, internal customer delays, or lower close confidence than management expected. So I would not give IBM full credit for those deals until they become signed revenue, cash flow, or at least very specific closed-loop disclosure. Fifth, IBM still has a large debt load. At the end of Q1, the company had $11.8 billion of cash, restricted cash and marketable securities, and total debt of $66.4 billion, including IBM financing debt. That does not mean IBM is financially unsafe. But it does mean the company cannot casually miss execution while asking investors to pay a confidence premium. The dividend also cuts both ways. IBM increased its quarterly dividend to $1.69 earlier this year and said it was the 31st consecutive annual quarterly dividend increase. For income investors, that is attractive. But for growth investors, the question is whether cash is being balanced correctly between dividend, debt, acquisitions, AI investment, quantum investment, and organic growth. When execution is clean, that balance looks disciplined. When execution misses, investors start asking whether too many priorities are competing at once. That is why today's drop matters. It is not only about Q2, it is about the number of promises attached to the IBM story. AI, Red Hat, Confluent, HashiCorp, mainframe, consulting, security, quantum, dividend, free cash flow, and debt discipline. That is a lot of moving parts. And when a company with that many moving parts says large deals slipped and execution faltered, the market lowers the benefit of the doubt. The next proof event is July 22. That is when IBM is scheduled to hold its regular Q2 earnings call. Here is what I would listen for. First, guidance. Do they maintain the full year revenue and free cash flow framework? Do they lower it? Do they say the miss was mostly timing? If they say timing, what specifically moved into Q3 or Q4? And just as important, what happens to 2026 and 2027 expectations after the call? The stock cannot rebuild the old valuation only by saying the deals are still alive. Analysts need enough detail to rebuild their models. Second, software quality. Software up 5% is not enough detail. I want the split. How much was Red Hat? How much was transaction processing? How much was automation, data, AI, and security? Was the weakness narrow or broad? And what was organic software growth, excluding major acquisition effects? Third, mainframe cycle. If Z17 is still nearly 130% program to program, why did Z performance and the associated software stack disappoint? Was it shipment timing, customer timing, software attach, budget shift, something else? Fourth, large deals. When management says numerous large deals failed to close on expected timelines, I want to know whether those deals are still alive. Did they slip into July? Did they slip into the second half? Were any lost? Were customers reprioritizing temporarily, or were they pushing back on IBM's value proposition? Fifth, consulting. Consulting was flat, up 1% at constant currency. Consulting signings were described as growing, helped by Gen AI. That can be good, but signings have to convert. If consulting is the route into enterprise AI workloads, flat reported revenue is not the proof investors want. Sixth, capital allocation. IBM is funding dividends, acquisitions, AI commitments, and quantum investments while carrying meaningful debt. I want to hear how management protects free cash flow if revenue growth disappoints. I also want the debt bridge, total debt, financing debt, core debt, cash, and net core debt. Seventh, accountability. Management already admitted the team did not adapt and move quickly enough. That is useful honesty. But the call needs more than honesty. It needs operational correction. What changed? Which sales motions changed? Which forecasting assumptions changed? Which deal review process changed? Which customer budget signals did they miss? That is the real test. Here's the simpler version of my scoreboard. I get more bullish if management can say the slip deals are still alive, some already closed after quarter end. Software weakness was narrow, not broad. Red Hat and the newer data assets are still accelerating. Free cash flow guidance is intact, and the company has made a specific sales forecasting correction. I get more worried if the call sounds vague, if management says timing but will not quantify the timing, if transaction processing weakness looks bigger than one quarter, if consulting signings sound good but revenue stays flat, if full-year guidance needs a major reset, or if the answer becomes too much AI, quantum, and long-term vision, and not enough operational detail. Here is where I land right now. IBM did not become uninvestable because of one preliminary quarter. But IBM did lose the right to be treated as boringly reliable until management earns that back. The drop makes sense to me because the market was not just pricing current earnings, it was pricing trust. Today, that trust got marked down. Actually, I would say three things got marked down at once: the execution premium, the software and AI transformation premium, and the quantum policy optionality premium. The market may have removed too much, it may have removed the right amount. But the reason the move is so large is that all three premiums got questioned at the same time. The bull case is still alive if three things happen. One, IBM proves the large deal slippage was timing, not demand loss. Two, software reaccelerates or at least shows that the weakness was narrow and explainable. Three, free cash flow and guidance remain credible enough to support the dividend, debt plan, and investment roadmap. The bear case gets stronger if the July 22 call is vague. If management cannot explain which deal slipped, if software weakness looks broader, if transaction processing pressure is not temporary, if consulting signings fail to convert, if full-year guidance comes down hard, or if the company leans too much on AI, quantum, and long-term language, while near-term execution remains messy. That is the line. I would not make this video about whether IBM is cheap after a one-day crash. Cheap compared to what? Cheap compared to yesterday's confidence premium? Maybe. Cheap compared to a lower growth, less predictable enterprise tech company? That is a different question. The stock price fell fast. The evidence now has to catch up. For me, the cleanest title of the story is this: IBM did not break as a company. The confidence premium broke as a stock. And the next call determines whether that premium starts to rebuild or whether the market decides the old, boring IBM was safer than the new, ambitious IBM. Quick reminder, this is research, not financial advice. I am not giving a buy, sell, or hold recommendation. The live price move should be refreshed before recording because the exact percentage can change. The real work is not reacting to the red candle. The real work is understanding what changed in the evidence.